Hello, everyone. Daniel Snyder from Seeking Alpha. Thank you for taking the time to join us today as we talk about high conviction stocks for uncertain markets and uncertain indeed, as we've all been hearing about treasuries and bonds and what's going on with consumer sentiment, jobless claims, all the things, and the employment. So we have none other than Stephen Kress, the Titan quant man himself, joining us today to not only give us the macro overview, but also a couple stocks that might be poised for great success from here. So before we get into the conversation with Steve, let's go ahead and knock out our quick legal disclaimer. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, or strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions, Stephen Kress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed securities dealer, broker, or U.S. investment advisor or investment bank. All right. Now that that's done with the man, the myth, the legend, Stephen Kress. Steve, how's it going?
Doing well, and thank you for that warm welcome. It's been a nice couple of weeks to see a little bit of a reprieve in the market, but it could also be tricky, a little bit of a head fake. I think there's still a lot of uncertainty out there. So I appreciate you organizing this call today. And there is still a lot of uncertainty out there. And what we wanted to do today is provide a couple stocks that could see us through periods of uncertainty, almost sort of like safe haven stocks. We've had a good rally off the bottom. And in fact, it's hard to believe, but at one point, the S&P 500 was 15% off its 52-week low, and now we're back to almost flat year to date. And there have been a couple of factors why the market has come back. Daniel, I'm going to go over those factors and still what's creating some uncertainty out there going forward and why we still want to highlight a couple defensive-oriented stocks that could prepare us for the uncertainty of tariffs. So a little bit about this presentation today. We'll cover the markets and the economic backdrop, our high conviction stocks for tariff uncertainty. And we'll get right into it within a few minutes. First, I just want to tell those individuals who are new to Seeking Alpha a little bit about our quant system. So for the most part, quant is very similar to fundamental research. If you had an analyst that worked at Morgan Stanley or Merrill Lynch, or any of the major investment banks where there are traditional analysts, our system is similar in that we look to identify factors such as value, growth, profitability, and a couple other factors that we use on our quant side to select stocks. However, the real difference is between quant and individual analysts is an individual analyst is really only capable of maybe covering 15 to 20 stocks, where with our quant system, due to the powerful computer processing we have at Seeking Alpha, it gives us the ability to actually analyze every stock every single day. And for the most part, that's really investable stocks that we look at. And with our approach, we actually utilize a strategy, which I refer to as GARP, which is growth at a reasonable price. So what we're doing is we're trying to identify stocks that are collectively strong on value, growth, profitability. We also look at earnings per share revision, and that's kind of proprietary to Seeking Alpha. It's not the revisions, but what we actually look at is the quantity of analysts that are taking estimates up or down on a stock, and we measure that against what analysts are doing for the entire sector. So that's the proprietary aspect. And we also look at momentum as well. And when you put this into an algorithm and a computer model, it gives us the ability literally every day to go through balance sheets, income statements, cash flow statements, and hundreds of financial metrics for every stock and compare it to other stocks in the sector. And that's the power of quant. So again, it's very similar to what a fundamental analyst does, but it just gives us the breadth to check out every stock every day and refresh it with a daily recommendation, buy, sell, or hold.
And all before the market opens, which is the
All
best.
before the market opens. Yeah. Typically between about 4 a.m. and 6 a.m. every day, we run our system. And it goes through literally close to 5,000 stocks. Most of them are US stocks and ADRs. So that is, most of the investable universe that's out there. And, just to put it in context, when you look at a research report from an analyst at, say, Merrill Lynch or Goldman Sachs, Typically, that report could be a week old, 2 weeks old, 4 weeks old. And when you read that, you make an investment decision, you're making an investment decision on something that's dated. I mean, the stock has traded quite a bit since that period. Metrics change. So for me, if I look at a research report from 4 weeks ago, it's like looking at a newspaper article from 4 weeks ago and trying to make an investment decision. I just wouldn't do it. I need my data to be refreshed every day because stocks trade every day. And with every trade, there's a new value placed on that stock. And as I mentioned, we have sort of a GARP-oriented approach where we look at growth at a reasonable price. And we have a good track record. So what we're showcasing here is over the last 5 years. On the far left-hand side, you'll see the performance of every single strong buy every day. Over the last 5 years, it's up about 285%. Compared to the S&P 500 for the same period, it's up about 100%. And you can see to the right of the SA Quant, which is on the far left, we also look at Seeking Alpha contributors. And in the third column, you'll see Wall Street analysts. So we actually look at the performance of the strong buy recommendations from all Wall Street analysts. And again, it gets rebalanced every day. And you can see over that 5 year period that the Wall Street analyst strong buys were up about 55% compared to our quant system up at about 285% for the same period. So I do want to add this is not an investable product. This is not a mutual fund or an ETF where we're showcasing this performance. The point of showing the performance is to identify that the strategy actually really works well. And that would be sort of our GARP strategy and our quant ranking system. So let me explain what's going on with the markets right now and a little bit of the economic backdrop so we have an understanding. Of course, March and April were incredibly volatile, just whipsawing all over the place. And then coming into May, it was really the reverse. But you could see in April, the U.S. announced some sweeping new tariffs, and it was known as Liberation Day on April 2nd, which included 10% baseline. And in many countries, especially our key trading partners, those tariffs were much, much higher. And the immediate market reaction was the S&P fell by about 4.8%. The NASDAQ fell 6%, which was its worst one-day correction since the pandemic. And the Dow Jones Industrial Average was down about 4%. The VIX spiked above 50, and that was a move similar to what we saw almost last July, where it was 60, which you rarely see. It was the highest since the pandemic, and it definitely created some recession fears when the VIX spiked to that level. The S&P has had some wild swings, gaining about 9.5% on April 9th, following the tariff pause. And that's kind of important because some of the biggest moves in the market often are right after the biggest correction. So kind of a testament to that you always want to stay in the market. You don't want to be scared out by those big correction days. And of course, there were escalating China-US tensions that led to more market turmoil during the month of April. And then came May, and things got a bit calmer, and the market started to rebound. The S&P finished slightly in the red for the month of April, but as of today, it's almost like unchanged year to date. The S&P experienced a 5-day rally during the week of May 12th through the 16th, and that was driven by a 90-day U.S.-China tariff pause. And that really fueled a lot of optimism that tensions were easing and that those tariffs would be removed. And at the end of the day, we all know tariffs are not good for the market. They're very inflationary, especially when it's on a large scale with a lot of different countries and a lot of different sectors. One of the other positive points was the U.S. and Saudi Arabia announcing a major AI deal, which really moved the tech stocks up. And inflation actually cooled more than expected in April, with annual inflation slowing to 2.3%, which was the lowest since February of 2021. And that came as a welcome surprise, especially since everybody has been so tariff focused and fearful of inflation. But really, if the tariffs do kick in, those inflation data points won't happen for probably like 2 or 3 quarters. So the inflation that we're seeing now is actually backward looking. So there are some really, scary signals that are still out there, and that there is a recession potentially on the horizon. And even in the last 5 days, you can see if you look on the right-hand side, I put up a table for the 5-day sector performance. You can see consumer staples, communication services, and utilities were the best performing sectors, and they were still in the red. They were still down. But if you looked at some of the sectors that have performed better over the course of like 2023 and 2024, such as consumer discretionary and technology, in the last 5 days, technology was down 2.39%, consumer discretionary sector was down 2.77%, and energy fell 4%. And usually that energy is a pretty good indicator of, people believe that energy is going to go down and that there's going to be a lack of demand for energy. It means that potentially there's going to be a slowdown on economy. So, that definitely raises an eyelid. So the US economy unexpectedly contracted by 0.31% in Q1, and that was largely due to the surge in tariffs. The housing market has been softening. US home prices moved lower in April, and that was the first monthly decline we had since September of 2022. US consumer confidence hit its lowest level since July of 2022. I'm going to show you a chart there. And that was the fifth consecutive month in a row that consumer confidence dropped. And a lot of the talking heads at the major investment banks have lowered their recession odds since the tariff truce, but risks remain. And then you'll hear some comments from the CEOs of these banks that are the opposite of what some of the strategists are saying. So it's a little bit confusing, what we're hearing from these banks.
Hey,
So
Steve, real quick on
yeah.
the energy sector stuff you were just talking about. Do you think there's any signal with energy seeing such horrible performance going into the summer traditional boom period, right? People thinking about like, well, shouldn't the price of oil and energy companies be doing good right now? Is there any signal there?
Well, I think that the signal is a couple of the combined signals that we'll see in these next couple of charts is that with consumer confidence being down, and fears of unemployment. So these are actually measured fears as indicators of unemployment going up. People are not traveling or do not have the same type of travel plans that they normally would over the course of the summer. Also, the tariffs have created a situation where the dollar has weakened against many foreign currencies. So to travel abroad, it's actually become more expensive. So you have more expensive costs, for going abroad, and then you have fears of like, booking major vacation homes and hotels for fear of consumer confidence and potential job loss. And I think that all contributes to energy prices going down. But more often than not, I'm seeing a lot of on the corporate level, companies pulling back on their CapEx. And that, is definitely a lead indicator as well as what's going to happen with the economy. And if that goes down, energy typically follows that down as well. And there's also potential a lot of supply, on the market too. Trump, wants to pump, and a couple, foreign countries potentially working on negotiations with Iran that would add to the market. Doesn't look like anything's happening from Russia right now, but certainly with the OPEC nations, it doesn't seem as if they're slowing down on production and they want to increase production here in the U.S. So there's a lot that is pointing to additional supply with less demand, and that means lower energy prices. So taking us to the next slide, this shows the target rate probabilities of traders for the upcoming Fed meeting, which is on June 18th, and 94% of them believe that rates will be unchanged. And I think what's really interesting, Daniel, if we went back to like October of last year,
Two
or
months ago, even
November,
2 months ago, they were expecting, I think,
right?
50 basis points.
They were looking in the first half of this year for a 50 basis point cut and maybe like even three or four cuts during the course of this year. And so far, we haven't seen anything. And when I look at this chart, every couple of weeks, it seems like interest rate traders just increasingly believe that there will be no change. So there's a lot of uncertainty there.
Higher for
Um,
longer.
yeah. So we were talking about consumer confidence before, but this is corporate confidence. You can see there's a massive drop in corporate confidence, and this is a U.S. CapEx indicator. And if U.S. CapEx is going down, that means companies are spending less, they're investing less, spending less, and that means less growth.
Steve,
So
I want to mention on this too, because
yeah.
I remember when I first brought this chart up a couple of weeks ago. Since then, I've spoken to somebody that's on a board for a major manufacturing company here in America, actually. And we were having this conversation about, well, the sentiment of the board and of the C-suite and how CapEx is being pulled back, as we're talking about here. And really, the big drive away, the takeaway of the conversation was those boards, those management teams are looking for stability from the countries they want to invest in. When they look across all the countries across the world, they need to have stability to obviously have the ability to forecast where price and revenues will be. And without that stability, you're seeing this pullback. It just doesn't feel like they're ready to spend the money
Yeah, and that is a massive drop that I believe you circled there. That is a really like pullback in CapEx spending,
quickly.
just a sharp, sharp drop. And it is accompanied by a drop in consumer confidence, which has occurred for 5 months in a row. So the combination of both corporate confidence and consumer confidence, uh, it doesn't instill you sort of with a great feeling for earnings in the next couple quarters. Um, and we also have a new chart that I have added here, which is consumers' anticipation of rising unemployment. So this is actually shows you sort of an indicator of what individuals believe in terms of the potential for unemployment going forward. And this was as of May 16th by the University of Michigan. And you can see this has surged as well. So it's a percent of consumers expecting more unemployment. And obviously that's not a good sign. It's just like, goes hand in hand with the consumer confidence which has been crashing. This is just going the opposite way, but they both mean the same thing. So we also had Moody's downgrade the U.S. Credit rating, and that hurt markets as well. And a little bit of why 5 days ago we started to see a shift back into some of the safe haven sectors, such as utility and consumer staples. We saw a little bit of a reprieve today with the House of Representatives being united, at least on the Republican side, behind further tax cuts. But that also means that the deficit could be larger, which sort of goes hand in hand with the U.S. credit downgrade. So that certainly didn't help either. Um, and the other thing that I really need to highlight is the the rally we saw, this relief rally that we saw occur after April into May. It really started when there was sort of a 90-day tariff pause announced. And it's something that we have to keep in mind is that this is just a temporary pause. It's only through mid-July. And as we get closer and closer to that July date, and we see less negotiations becoming solid agreements, I think fears potentially could start to increase again as we get closer to mid-July if we don't see more agreements with countries. So it's just something to be aware of. Businesses on the back of that could delay investments and supply chain decisions, as you saw already with that CapEx decline. That could actually get worse. And the bottom line is investors should be prepared, and I think the way to do that is to hold stocks that are more resistant to trade disruptions, offer greater stability should trade tensions renew. It's a fairly good hedge to have. And I had mentioned before, part of what we're seeing from chief economists and strategists from the banks are the complete opposite of what we're seeing from some CEOs. And Jamie Dimon, just a day or two ago, he said there is an extraordinary amount of complacency in markets about the risk of tariffs, stagflation, and geopolitical instability. Investors are not fully pricing in the potential for a sharp correction if these threats materialize. And it doesn't get much higher than Jamie Dimon. Like,
I feel
he
like he
runs
knows a
like
lot. I feel like they have a lot of research over there that he probably sees.
he's got his finger on the pulse of anything financial. So if Jamie Dimon is saying that it's worth paying attention to, doesn't mean that you get out of the market, but it just means you have to sort of allocate your assets, diversify your assets, and prepare for it. So, what makes a high conviction tariff resistant quant strong buy? Well, we're looking for companies that have domestic revenues. Companies that generate most of the revenue within the US are less vulnerable to import tariffs and retaliatory measures. We're looking at digital first services, firms whose core offerings are digital or service based, which are less exposed to supply chain issues and rising cost input. Diversified production, businesses with flexible or localized supply chains and minimal reliance on imported goods, which you can use to sort of sidestep the tariff-related shocks. And defensive sectors such as consumer staples have historically shown more resilience during economic downturns due to their essential nature. So people need toilet paper, people need bottled water. That's not going to go away. They will continue to buy that. So, one thing I want to say though, and I don't want people to get scared, okay, out of the market because it's really important. And this is kind of a good rule of thumb. At one point during the course of the year, the S&P actually was 15% off its high, but sometimes markets rebound and they pull back again. So one thing I really want people to keep in mind, we have looked back historically at the last 5 times that the S&P has pulled back 15% since 2010. And if you bought the market when it was down 15% and you held it for 2 years after buying it at that point in time, where again, it was down 15%, if you held it for 2 years, you were up almost 50%. And what's even more interesting is if you bought the top 10 quant strong buys at that same exact period where there was a 15% pullback, those stocks were up 117% on average. So certainly, when the markets pull back, you want to be prepared. You want to have some stocks of defensive nature, but you also don't want to ignore the stocks with good fundamentals. And if you're looking for a price point to enter the market, one of those good price points is when the market does come back down 15%. Obviously, the market can come down far more than 15%. We've seen periods in the past where it's down 22%, down 30%. But by rule of thumb, when it is down 15%, that is a fairly good entry point. And you sort of just grin and bear it if it goes down further, and have fairly good confidence that if you hold it for 2 years, you're going to be looking pretty good. All right. So that brings us to the point in the presentation, Daniel, that most people have been waiting for. Top high conviction stocks for tariff uncertainty. So our first one may not be any surprise at all. This is a stock that's typically pretty steady. Philip Morris. People seem to not really want to give up cigarette smoking or vaping. It's very solid, like day in and day out. They're in the stores, they're buying their vapes, they're buying the cigarettes. This company is huge. It's got a market cap of 271 billion. It is a quant strong buy, and it ranks number one out of 178 stocks in the consumer staples sector. And within the tobacco industry, we rank it number one out of 8. If you look on the far right side, you could see the factor grades for valuation, growth, and profitability. And it's important to keep in mind when you look at those factor grades that they're there to give you an instant characterization of how the stock compares to all the other stocks in the sector. So it's actually, those grades are on a relative basis. So it means in terms of the valuation, it's relatively a little bit expensive, and the growth is in line with the sector, but where Philip Morris is really strong, it has an A plus for profitability, an A plus for momentum, and analyst revisions. It also has a dividend, which is fairly safe. If you look towards the bottom, you'll see the dividend grades. The dividend safety grade is A minus, and the dividend growth grade is a B. So having a dividend safety grade at that level is very, very positive. Basically, anything that's a B minus or above for dividend safety, very high probability that that dividend won't get cut. Conversely, if your grades are below C plus to F, there's a much higher probability that the dividend could be cut. But just expanding a little bit on the company itself, we saw that there was 12%. The analysts are estimating about 12% EBITDA growth going forward. That 12% EBITDA growth rate is a 134% premium to the sector. In terms of trailing EBITDA margins, it's at 42%, which is a 216% premium to the sector. And in the last 90 days, 13 analysts have taken their earnings estimates up and 0 have taken it down. It also has a forward dividend yield of 3%, which is much higher than the S&P, which is around 1.2%. So our factor grades and basically the absolute data points look really good for Philip Morris, as well as that dividend safety grade. Our number 2 stock is a little bit really completely opposite, where Philip Morris is a consumer staple stock. Uber Technologies, ticker symbol UBER, is a growth company. It's a tech company. Still has a very large market cap at 185 billion. It's got a quant strong buy. And within transportation, we rank it 1 out of 8. And it's actually in the industrial sector. It's not a technology stock. Most often, I always think of this as a technology stock because it's been such a growth-oriented name, but it is really in the industrial sector where it's ranked 5 out of 617. It is a digital first service model to conduct trade within this type of industry. It's got a very strong growth rate. Active consumers are up 14%, and trips are up 18% year over year. The company has an incredible 74% return on equity, which is a 500% premium to the sector. That type of ROE. Goldman Sachs and Morgan Stanley would be dropping to their knees to get an ROE at that level. The company has a tremendous amount of cash from operations, $8 billion. And on a PEG basis, which is one of my favorite ratios, it's at a 38% discount to the sector. So actually, Daniel, what I want to do is I want to take us to the platform.
Yeah, while you're doing that, I think it's always interesting how they put Uber inside of the industrials because it's a transport company, but at the same time, it really is that tech
It
focus, right?
really is, yeah.
I feel like
It's
every
like
sector just needs to find a technology company to put inside of it.
it was probably really wise of them to get that classification within the industrial sector because their growth is so far superior to the rest of the industrial sector. And that's why you see that A for growth. And again, just as a reminder, these factor grades, they're relative to the sector. So, for example, when you see that A, you know that its growth is far stronger than the industrial sector. So I'm going to click on that. And this is basically a straight A report card for growth. Whether you're looking at year over year or forward estimates from analysts, you could see a lot of A's. So let's take just a couple. If we look at the forward revenue growth, it's at 15.9% compared to the industrial sector median, which is 4.4%. Then if I go down for the EPS diluted growth going forward, the EPS growth rate for this company is 58% versus the sector median at 7%. So you can see why we like this company so much from a growth standpoint. And of course, all these rides, they are global, but they're not necessarily really reliant on a supply chain. It's software based, and their clients within each of the markets is very local. So it really makes a great tariff resistant company. If we were looking at profitability, you could see gross profit margin is a little bit better than the sector, but where it looks really great is the net income margin at an A plus there. And then when we get to the return on equity, an A plus is absolutely huge. Um, so I'll also go to the revisions grade so we can see what other analysts are saying. So in the last 90 days, 39 analysts have taken their earnings estimates up for this stock, and only one has taken it down. So there is a lot of positivity on the part of financial analysts in terms of what this company's earnings growth rate is looking like going forward. So I just wanted to share what that looked like. And if we scroll down, again, you can see within in the industrial sector, it actually ranks number 5 out of 617. So I actually I want to click on that, Dale, because I'm quite curious what four stocks within the industrial sector actually have a higher ranking than
Funny, I
Uber.
was just looking at that.
Okay, so we have a construction machinery and heavy transportation equipment company called Microvast Holdings. We have Bitcoin Depot, and we have Air France and Limbach Holdings. So if you're curious and you're a premium client, you can definitely check those stocks out. If you're not a premium client, this is a great way. If you have any interest in what companies rank at the top of each sector or industry, this is a great way to find it out. I'm
Yeah,
going to take us back to our
Air France is surprising on that list, having an airline on there, right? You're talking about you want an airline? Do you
Let's
want
click on it.
cars?
So
Do you want a technology app that just connects drivers and passengers? I think
yeah,
Uber every
but
day.
it is interesting. So since you brought it up, it's ranked number 3 in the industrial sector, and you can get detailed information on it within one click. And quite interesting, you'll see Wall Street actually has a sell on this. So the consensus from Wall Street is a sell, but the quant recommendation is a strong buy. So year to date, the stock is up 14%. So that pleases me. The quant has gotten that right because the market's really flat. So the fact that this is up 14% year to date, it's a really good sign. And as you can see from a quant standpoint, the valuation looks great compared to the sector. The growth rate looks really strong versus the sector. Profitability looks great versus the sector. So quite interesting that the Wall Street consensus is sell, while quant is a strong buy, and it looks like quant wins in this case. I'm going to take us back to our slideshow, and we're going to go to stock number 3, which is Stride, ticker symbol LRN. This is an educational company. So really, even if it's global or even if it's just within our own domestic market. Again, this is a service that is not dependent on a supply chain. It's provided in each country. As I mentioned, this is educational services. Within consumer discretionary in that sector, it ranks number three out of 477 stocks. And within the educational services sector, it ranks 3 out of 25. This specifically is a US ed tech company with a digital first service based model. So again, the tariffs are really not going to impact that. And interesting, less than 5% of the revenues come from federal resources, which I think is probably reassuring to many individuals that would be looking at this, since a lot of federal grants have been canceled, and the federal aid that is provided on a state level has been clawed back. So I think it's a real positive sign that less than 5% of the revenues come from federal resources. So when we look at this company, on a trailing 1 year basis, it's up 124%. The forward EBITDA growth rate is 28%. That's a 649% premium to the sector. It's huge. Its return on equity is 24%, 106% premium to the sector, and the PEG is 0.5 times. So on a valuation basis, even though that overall value grade, if you look at the far right, you'll see the value grade is a D plus, and that tells you it's a little bit expensive. But if you look at PEG, which is one of my favorite factors, that actually combines growth and value together in one factor. It looks very strong. So I find that positive. And then the revisions grade is an A plus, momentum is an A plus, and growth is an A minus. So I'd say a lot of these factor grades look great for Stride. Number four is Care Trust REIT. This is a real estate investment trust, ticker symbol CTRE. And this one specifically focuses on healthcare REITs. And within that segment, it ranks 1 out of 17. And out of our REITs overall, it ranks number 4 out of 174 REITs. So you can see the valuation of this is in line with a group with the factor grade being at C plus, but the growth very strong for this REIT at A plus, very profitable at A, momentum very strong at A, and analyst revisions at B plus. We look at some different metrics for REITs. We look at AFFO and FFO, and on an AFFO basis, the forward growth rate is 10%, and that's huge for the REIT sector. It may not seem like a big growth rate, but compared to other REITs, that is a really tremendous growth rate. The FFO margin is 103%. That is huge. The interest coverage ratio is 9.2 times for an FFO interest rate coverage, which is an excellent ratio. And the forward dividend yield on this is 4.65%. That is more than 4 times the yield that you would get on the S&P. So really good yield there. And of course, sometimes when markets correct, if you have a stock that has a decent dividend yield, that helps gives you some downside margin in times of correction. And usually those stocks do not get hit quite as hard. And number 5 on the list, Daniel, is Pilgrim's Pride Corporation, ticker symbol PPC, a huge company with a market cap of 12 billion. Again, this is as you probably are well aware of, it's in the packaged foods and meat, lots of chicken with Pilgrim's Pride. It ranks number 13 out of 178 within the consumer staples sector, and within packaged foods and meat, it's number 2 out of 51. There is geographic diversification with this company, but it is also vertically integrated, which helps buffer against some supply chain tariff issues and disruptions. It's really quite inexpensive. It's PE on a forward basis is only 9.3 times. So it's about a 43% discount to this sector, and it's at a huge discount to the forward PE for the S&P. Their EPS, the forward EPS, and this is not trailing, the forward EPS growth rate is 49%, which is huge versus the sector. The return on equity is 37%, and the cash per share, they are cash rich at $8.71 per share versus the sector at $1.80. So Pilgrim's Pride, it's been a fairly stable stock. There's been some up and down, some uncertainty over tariffs, but for the most part, I feel like the C-level executives have really talked through investors on the tariff side. So there's a lot of comfort with the geographic diversification that the company has and their supply chain. So here it is, our top high conviction stocks for tariff uncertainty: Pilgrim's Pride, Uber, Stride, CTRE. Um, NFG was an old one,
Yeah,
and
yeah. I was gonna
Pilgrim's
say
Pride.
NFG is the old one on there.
Yeah, that was an old one. So yeah, here are our five:
Yeah.
Philip Morris, Uber, Stride, Paratrust, and Pilgrim's Pride. So we'll ignore the NFG. That was an old one there, but good grades.
Still has good grades. I was gonna say, yeah.
Yeah. Look, this is a lot of work. If you're a premium customer, researching stocks takes a lot of time, a lot of discipline. We created a product, Daniel, a little bit over 2.5 years ago for people who are engaged and like investing in stocks, but don't necessarily have a lot of time. Some people just want us to send them our best quant recommendations. So we have a product called Alpha Picks. And with Alpha Picks, each month I give my two top recommendations, typically on the first of the month and the 15th of the month. And our return since its inception in July 2022 has been exceptional. Alpha Pix is up 156% versus the S&P up 54%. Over the last month, it's had an exceptional return too. It's up about 20% over the last 4 weeks versus the S&P up 13.4%. And the 1 year return is really in line with the S&P. And I will say, pretty much every period that we looked at for Alpha Pix since inception, it pretty much was destroying the S&P up until February of this year. And then a lot of the stocks in Alpha Picks, when the market started its rotation into cash and consumer staples and REITs and healthcare, a lot of people sold the stocks with strong fundamentals. And um, if you read a few of my articles or were on a couple of webinars, I really said this is an ideal time to be looking at stocks with strong fundamentals, because it's when you enter those market corrections that sentiment and fear drive markets, and people sell typically the stocks that have done really well, where they made a lot of money, to raise cash and allocate to some of the more defensive sectors. And we did see that occur during really late February, March, and April. But over the last 4 weeks, we've seen a huge return. And as you can see, the 1 month return for Alpha Pix is up 20% versus the S&P up 13%. But the point of today's presentation was really like, don't be totally confident based on what you see on April, thinking that's going to continue for the remainder of the year. There's still a lot of uncertainty out there. So that's why we wanted to introduce some stocks that could be tariff resistant, as uncertainty is still out there. But for investors who would like to rely on a system and have those picks hand delivered to them twice a month, Alpha Picks is a pretty good way to go. Daniel, that's really the end of the presentation. I want to open up to questions if you have any.
Yeah, well said. Before we dive into some questions, there's some good ones in here. I just want to mention as well, earlier today, I was curious. I was like, well, Steve does all these webinars. He's done all these events for us. He has Alpha Picks. How are your returns doing across the board with all these quant stop picks? And also the top 10 picks from January. I don't know if you remember when we did that digital event. Your top 10 picks are up about almost 11% year to date. It's like during this market uncertainty, just watching the returns and sitting on that cushion and just sleeping well at night. I mean, I can't thank you enough for all the ideas. I know everybody here as well is always saying thank you, and they want to buy your Seeking Alpha mug that you have over there. But they can't thank you enough. So I just want to make sure that you know that you're appreciated.
Thank you.
So going into some of the questions here, one of the questions that came up is a lot of these stocks that you present are typically near their all-time highs or close to the 52-week high. Does that worry you at all when you go into these names?
That does not worry me. Momentum is a really important factor. So there are hundreds of factors. If you break down value, profitability, growth, within each of those groups, there are many, many underlying metrics. And there is empirical data that goes back over 200 years that shows you that momentum is the most important factor. And just sort of like a rule of thumb, if you were to take a basket of 10 stocks that were near its 52-week high versus a basket of 10 stocks that were near its 52-week low, and you held those for a year, you would be far, far better off in terms of your performance buying the stocks that were near a 52-week high. And the reason is these companies are doing something right, or the sectors are working. So it doesn't bother me that they're near that 52-week high. And there's still a lot of uncertainty out there. And that's why people are in these stocks. But importantly, these stocks, and the reason why I've selected them is they are at the very top of their sectors. So as a company within those sectors, they're doing something right. So you don't need to just like own the overall sector because there's a chance that if things were to improve, the sectors could sell off and you would sort of be caught flat-footed. But with the companies that we're highlighting, since they're the best within their sectors, that is something to pay attention to. And those earnings growth rates that we highlighted are huge. The valuation frameworks are typically in line or attractive. And that's what you really want to look at. What is the valuation framework? What is the growth now? How does it compare to the sector? And that's really how you make your decision. The fact that if it's at a 52-week high or somewhere in the middle of the range shouldn't really make much of a difference. But momentum is an important factor. That's why we do have it. And we stick with the stocks that have strong momentum.
All right. For this next one, I'm gonna blend two questions together here. There was a couple of people that were asking, well, how do I know? Say I buy these stocks now. How do I know when to get out of these stocks? When do I sell these stocks? And then maybe for the second part of that is also how do you sell the stocks in the Alpha Pix portfolio?
Yeah, so you use the Alpha Pix portfolio as a good rule of thumb. A hold is a hold. It doesn't mean sell. So a lot of times, we'll buy a stock when it's a strong buy or a buy. And if it drops to a hold, it could really just be temporary. It could be, that the valuation framework has gotten a little bit expensive, but the growth is still intact. And that's really no reason to sell a stock because valuation gets a little bit expensive. Look, quant is a data-driven system. So there has to be a threshold where those factor grades will change. And when it hits a certain point, so by example, the stock has a valuation grade of D and it drops to D minus, that stock's going to go to a hold from a buy because it's across that threshold. But within 3 days, that valuation framework could change and it could go back from a D minus up to D plus or a C. Um, so you would have missed out if you sold on that. So a hold is a hold. How do we know to sell? When the stock rating changes to sell or strong sell, that's how we know to get out. And I will say, rule of thumb with Alpha Picks, if a stock has been a hold for 180 days, at that point, it will take it out of the portfolio and we'll make room for some of the new strong buys.
All right, well said. There was another question about, is there any typical hold time that you have in mind for these positions? Maybe just from a different perspective, explain how the quant handles time length.
Yeah, so the time answer is answered every single day. So we refresh our data every single day. So every day is a brand new valuation framework. Every day is a brand new growth framework. So long as a company is growing faster than the sector and the valuation framework is better than the sector, that stock will most likely stay a strong buy. But as soon as that valuation framework changes or the growth changes, and that gets reflected again on a daily basis, we change those numbers. If it changes, that's how you know when it might be time to get out of a stock. But a stock could stay a strong buy for years if its growth rate is superior to the sector and the valuation framework stays in line. And one of the things that I want to take us back to the platform, and I'm going to show us. Uh, so as we're looking at this, you can see over here, we have Air France up. Daniel, see Air France on the screen?
You see it.
All right, so on the right side, you'll see the factor grades. You can see those factor grades. We show what it is right now. And we also show it sort of on a basis comparing to where it was 3 months ago and 6 months ago. So what I love about these factor grades is overall the factor grade shows you where it is relative to the sector. So that growth grade where you see a B plus, it's growing stronger than the sector. But you could also look at where this was versus the sector 3 months ago and 6 months ago. And Air France 6 months ago, that growth grade was a D. Okay. So at that point, that probably was not a strong buy recommendation. 3 months ago, it probably wasn't a strong buy recommendation, but that growth grade changed to B plus. So I'm going to show you, and we're very transparent at Seeking Alpha. If I click on the ratings page here, this will actually show you the history, and you can see it right here at what point in time we went from a hold to a strong buy. And you can see it was pretty recent. So that as I scroll down, you'll see right over here where that hold on April 24th, it was a hold. April 25th, it was a buy. And then April 28th, it went to strong buy. And you could see that EPS revision grade had changed from D minus, F, then it went to C minus, and then to an A. And now it's at an A plus. So analysts all of a sudden started getting really positive on Air France. And that's how we knew. Conversely, the same way when those grades come off, okay, you'll be able to see it and a stock will go to a sell.
Well said. There's a quick question that came in here. Why so much is the focus on comparing the stock to its sector versus its industry?
So sometimes in the industry, you might only have 10 stocks. And from a quantitative perspective, that's really not a deep enough sampling group to make a comparison. So we go with the sectors overall, which typically have hundreds of stocks within a sector. Um, but the great thing is when you're looking at this, you can see the rank within the industry. So you can see where it is versus its peers. And if it's ranked, very high on a sector basis, chances are it's going to be at the top of its group on an industry basis. So we do show both the sector and the industry, and people have that option.
All right, we got a question here. Steve, how do you handle portfolio weighting of positions? I mean, maybe that's a little, maybe you talk about alpha picks and as well the stocks we talked about today.
Portfolio weighting positions. Okay, so within Alpha Picks, we add stocks to it. So it typically starts off at a fairly small position, but if the performance of the stock grows over time, that weight gets larger. So that's how it works with Alpha Picks. But Alpha Picks, we're looking for two new ideas every month. So we're continuously adding where, many people all have a fixed portfolio of say 30 stocks. So then you'll probably equal weight it across those 30 stocks, or you could market cap it. Yeah, weighted. Companies that have a bigger market cap weighting will get a higher weighting. So it really depends on, which approach you're using.
All right, we got Denise here in the chat asking, in alpha picks, does Steven talk about taking some profit off the table along the way with your positions?
Um, we have sort of that hard and fast rule where a stock will drop to hold and we'll keep it in the portfolio for 180 days. And after 180 days, we will take it out. However, there is another rule. If a stock does extraordinarily well and it becomes a 15% position, we will reduce that from 15% down to 10%. And the reason we do that is a lot of people will be fresh to and new to Alpha Picks. We don't want them to immediately have a 15% position in their portfolio. So the rule does work well. At a really timing, one time we had a stock called Super Microcomputer. Um, and that stock was up almost 1,000%. And really in a very brief period, it surged, and it went from like being 12% of the portfolio to 15% to 20%. And at that point, we cut back from 20% to 10%. And sure enough, the stock actually started coming off after that. So the timing did work really well.
All right, we got a question in here. Steve, do you have any thoughts on how the big, beautiful bill might affect the markets going forward?
So historically, what I have found is there is concern when you have bills like this initially that it could add to the deficit. But what we find later down the road is that consumers have more money in their pocket and companies have more money in their pocket and spending increases. So typically later in the road, it is helpful to have those tax reductions. But the immediate reaction, sometimes there's uncertainty because it means that the government could be adding to its debt level with tax cuts. So it depends on how it plays out. If they find that the economy is stimulated and it typically generates growth, which does happen with massive tax cuts, that usually does benefit in a long period. But in the interim, takes a while to figure out if it will be act as a stimulant or not.
Do you think that'll lead to inflation?
Do I think that will lead to inflation? There are a lot of components for the inflation right now. The tariffs, obviously, if those stick, that is incredibly inflationary, and that typically leads to recessions. So, one of the reasons why politicians really stay away from it is there's been four periods in US history, and the worst being like in 1930, where we had global tariffs. Most of the tariffs since 1930, the other three times, were pretty much limited to one country or one sector. The last time we had global tariffs was in 1930. Of course, we had a market correction in 1929. The market in 1929, after that correction, actually came back a little bit. And then you had the global tariffs, and that was horrible. Inflation went through the roof, and the market really pretty much tanked between 1929 and 1931. Just got completely clobbered. So that to me is more of a concern. Um, we're trying to bring employment back to the US. And by cutting off our foreign supply, it will force companies to have to try to buy within the US. Usually that's inflationary as well. So you'll find like US companies like, and even companies like Ford and GM have already started to increase the prices on their cars. Um, if these tariffs like continue with Canada, and we have a lot of lumber that comes in from Canada, that creates inflation as well. So that's typically where the markets are more concerned. Um, I think, if the tax cuts are effective, hopefully it creates a little bit of stimulus for the economy. And that could benefit the market and it could wash out issues with the tariffs. Could.
Well, we're all hoping for the best, obviously. So we're gonna go ahead and start wrapping up here. Obviously, everyone, if you don't already, go follow Stephen Kress's author profile here on Seeking Alpha, where he's always putting out great timely research. You can message him there, or if you're an Alpha Pick subscriber, you can always jump into the comments on all that amazing analysis and articles that y'all are doing over there. If you have any questions for Steve, I highly encourage you to do so. Steve, can't thank you enough for these stock picks. I mean, obviously, as you mentioned earlier, it is just a pause on possible tariffs. There is still a lot of uncertainty. People are watching the macroeconomic data. Seems like we're every week is a decade almost at times right now. So we can't thank
It
you
feels
enough.
that way.
That steady hand. And everyone, thank you for taking the time to hang out with us today. Or if you're watching the replay, thank you as well. Don't forget to go check out Alpha Picks. And everyone, we'll see you in the next webinar. Take care.
Thank you very much, Daniel.